From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, financial quarterback since 1993. Joining with me today is Mark Sipos, the director of LFG Taxes. And so after the first year under the big, beautiful bill, what do you see for business owners out there?
Well, the big picture is planning certainty. Several provisions that owners have been watching are now extended or even made permanent. That does not mean every owner should rush out and spend money, but it does give owners and their advisors much more clarity when planning equipment purchases, research costs, borrowing, and even future cash flows.
So let's just start with one of the biggest items for pass-through business owners, which is the qualified business income deduction.
Right, the QBI deduction can allow eligible business owners of pass-through businesses like S-Corps, partnerships, LLCs, and even sole proprietorships to deduct up to 20% of their qualified business income. Now that was set to expire, but it's made permanent, and this is very important. The eligibility reference to a lot of different factors though, so you have to be careful.
So what about businesses that are buying equipment and investing back into their companies?
Yeah, this is another major area. So the law restored a permanent 100% bonus depreciation, and it also expanded the 179 expensing. So in plain English, that means businesses can write these off faster, and it really improves cash flow because you get that deduction up front.
And there's also been some changes in terms of research and development. So what changes are there and how could they benefit?
Well, the research and development costs can now be pretty much expensed immediately. In prior law, you had to expense them over several years. Improving processes, building software, investing in innovation, all of these can be expensed immediately and really improve cash flow.
What if you have business interest expense? How could that be treated?
Well, the law restores a more favorable calculation in deducting business interest expense. That may help companies that are really capital intensive or maybe need to borrow to expand, buy equipment, or fund growth. But not every owner is effective, and there's a lot of limits, like every law, and a lot of exceptions to it. So the point is that debt, cash flow, taxes, and growth plans should all be reviewed together.
So the bottom line is that the bill creates some opportunities, but also some complexities.
That's right, Jim. The biggest mistake would be treating this as a checklist for deductions. For business owners, the best approach is to coordinate your tax plan with the business plan and make sure you're taking an overall big picture look and making sure everything's coordinated together to get the best results.
Well, thanks, Mark. If you're a business owner, the question is not just what deductions are available. The better question is, how do these changes fit into my business, my taxes, and my long-term financial plan? At Lineweaver Wealth Advisors, we help business owners coordinate their taxes and all the other things that Mark mentioned today. So if you'd like a second opinion about your investments regarding your business or your personal financial plan, visit lineweaver.net and schedule a conversation today. Here's Fox News Sunday.